Ladies and gentlemen, good evening. My name is Thomas Jordan, and I'm the chairman of the governing board of the Swiss National Bank. We are very pleased to welcome you all to the 5th edition of the Karl Brunner Distinguished Lecture. We are delighted and honored that Carmen Reinhart has accepted our invitation to give the lecture. This lecture was planned for September 2020, but had to be postponed by 1 year due to the pandemic, with the hope of welcoming Carmen and all of you in person here in Zurich. Given the still difficult situation with coronavirus, this has unfortunately not proven possible. Consequently, the 5th Karl Brunner Distinguished Lecture now takes place in a virtual format. The Swiss National Bank established this lecture series in commemoration of the Swiss economist Karl Brunner, who was one of the leading monetary economists of the 20th century. Our aim is to contribute to the public debate on questions related to our mandate by inviting prominent academics whose research is relevant to central banking. Carmen Reinhart is one of the most cited economists in the world, with contributions that cover a remarkable variety of topics, including financial crises, exchange rate policies, and public debt. Despite her impressive academic track record, Carmen has had at least one foot in the world of policymaking throughout her career. Given her influence among both academics and policymakers, Carmen is an ideal person to hold the Karl Brunner Distinguished Lecture. Karl Brunner himself maintained close contacts with decision makers around the world, always emphasizing the importance of a continuous dialogue between academia and practice. Now, Carmen's biography reads like a screenplay for an American success story. She was born in Havana, Cuba. A few years after the regime of Fidel Castro came to power, Carmen's parents emigrated to the United States, leaving almost all their belongings behind. Carmen arrived in the United States at the age of 10, barely speaking any English. The family settled in Florida, where Carmen attended college. After finishing college, Carmen moved to New York to pursue graduate studies in economics at Columbia University. She then embarked on a successful career on Wall Street, where she rose to the position of chief economist at the investment bank Bear Stearns in the 1980s. After a few years in the financial industry, Carmen decided to return to Columbia to finish her dissertation. This was followed by an 8-year spell at an International Monetary Fund before Carmen was appointed professor at University of Maryland in 1996. In 2012, Carmen moved to Harvard University, and since June of last year, she has been chief economist at the World Bank. Now, Carmen's influence on the profession is also reflected by the fact that she has coined a number of terms that have since become part of economists' vocabulary. Every student of international macroeconomics learns about twin crises, situations in which banking and currency crises occur simultaneously. The term goes back to a paper written by Carmen and Graziella Kaminski, which demonstrated that these two types of crises often go hand in hand and reinforce each other. Another well-known term coined in Carmen's work is debt intolerance, which refers to the tendency of emerging market governments to default at relatively low levels of debt. Carmen's research is distinguished by her extensive efforts in collecting and compiling historical datasets. This is best exemplified by her famous book, This Time is Different, 8 Centuries of Financial Folly, co-authored with Ken Rogoff, who, by the way, gave the Karl Brunner Lecture in 2016. Based on a vast dataset covering several centuries, the book documents the way in which financial crises have repeated themselves over and over again in history, often following similar patterns. Even when the signs of an impending crisis are there for anyone to see, people usually find good reasons why this time is different. Such a failure to learn from history often turns out to be the breathing ground for the next crisis. With their book, Carmen and Ken accomplished the seemingly impossible task of writing an international bestseller consisting mostly of economic data and analysis. For anyone familiar with Carmen's work, this does not come as a surprise. Besides being an outstanding economist, Carmen is also an excellent writer. She writes on apparently dry economic topics in a captivating and entertaining way. It is fair to say that this is not the norm in our profession. Now, Carmen's research in economic history involves spending countless hours in libraries, consulting obscure sources, some of them centuries old, in the search for economic data. Carmen has compared her endeavors in finding and analyzing data both to archaeological expeditions as well as to the detective work of Sherlock Holmes. While this sounds rather exciting, the process can be painstaking. Carmen once described an episode where she found herself at 3 o'clock in the morning counting the number of zeros in records from countries that had experienced hyperinflation. Of course, with such a tiring task, a little help can come in handy. If the legend is true, Carmen's husband and frequent author, our friend Reinhart, once put together almost all the economic data published by the League of Nations and gave it to Carmen on Valentine's Day. Maybe Carmen can tell us a little bit more about this most unusual gift. Now back to Carmen's economic research. Carmen's specialty is to draw lessons for the present by studying the past. Taking a long-term view helps to put things into perspective and reveals that there are often historical analogies to contemporary situations that may at first seem unprecedented. Carmen's work reminds us that the financial crisis of 2007 and 2008 was far from unique in economic history. However, when it comes to the coronavirus pandemic, even Carmen concludes that this time truly is different. The global lockdowns imposed as a reaction to the virus are something the world has never seen before. Today, Carmen will talk to us about monetary policy in times of high public debt. Carmen has published extensively on the various implications of high public debt. For instance, in an influential paper written with Maria Belens-Brancha, Carmen showed how Western governments managed to repay their debt after World War II through a set of policies known as financial repression. Measures such as legal ceilings on interest rates and restrictions on international capital flows created an environment where domestic savers had no other option than to invest in low-yielding government debt. Financial repression was particularly effective in liquidating public debt when accompanied by a steady dose of inflation. The relation between monetary policy and government finances is an old and critical issue in central banking. It is also a very timely topic, given the massive increase in public debt that many countries have experienced since the outbreak of the coronavirus pandemic. We are living through times of extraordinary uncertainty. What we can safely assume, however, is that the interplay between monetary and fiscal policy will be among the key challenges that central bankers will face in the years to come. To cope with these challenges, Carmen's ability to take a step back and to provide us with a clear view of the big picture is most welcome. With this, I conclude my remarks and I look forward to a stimulating talk and discussion. Carmen, the floor is yours.
Well, I cannot say that I've ever had a more fabulous introduction. I am honored and I am very flattered by your remarks. It's a real pleasure and to reiterate, a really big honor to be here. Now, what I would like to do is deliver on that big anticipation. It's a tall order that you've laid out, and I hope I can deliver on that score. So, indeed, my aim today, before turning to the actual aim, let me say a word about the background material to my talk. I sent, which I think will be publicly available, a very large set of slides with stylized facts and material. I will be more focused in the discussion, but I hope you find also the background material useful. Um, so what I'd like to do in terms of uh, laying out the structure of the talk is before anything importantly is clarify that what was just said about Vincent being such a romantic person and giving me a Valentine's Day's gift is absolutely true. It was the complete set of the League of Nations book. So but he really knows the way to my heart. Um, so and I also have to say that I cannot emphasize how much I would have rather done this in person, but hoping to visit soon. But with further ado, let me lay out the structure of what I aim to talk about. As the title uh, indicates, uh, my talk today is not primarily about debt. It is in the Karl Brunner legacy and the Karl Brunner tradition, very focused on monetary policy and central banks in the context of high debt. Um, Already, we heard about my work on financial repression, which importantly involves uh, the central banks and financial regulation. That work was largely uh, done and published right after the global financial crisis, and I do take some pride in highlighting that the big message, the big takeaway from that work was that we were poised for a protracted period of low interest rates. That was the message that it carried at the time, which has proven to be the case. So I'm going to divide the talk into first a big picture on the interaction between debt and central banks. Secondly, uh, talk a little bit about the historic episode of financial repression, but this talk is not about rehashing history. It is very much a talk about how it connects to today. So from that, I'm going to move on and lay out some basic stylized facts. Again, looking at the big picture with a big focus on central bank balance sheets, how big they've been on the issue, which is increasingly discussed, of fiscal dominance, central bank independence, size of central bank balance sheets, with implications for inflation and such. And then I'm going to uh, conclude by taking stock of where the similarities are between the post-war era of financial repression and what I call financial repression nouveau, which is what we've had since the global financial crisis, and discuss and hopefully continue to discuss also in the Q&A what this implies for monetary policy going forward. That's the structure or that is the um, planned agenda. Now, I would like to start out, even though I said this is primarily not about debt, but about monetary policy, to make the point that central bank independence, which at the moment the advanced economies very much take for granted, has had its ups and downs. And those ups and downs have importantly been connected to the level of indebtedness of the public sector, of general government. So, what this figure here shows is public debt as a percent of GDP in the advanced economies from 1900 to the present. And what you will notice, well, the first thing to notice is that we are now surpassing the established highs at the end of World War II. And you will notice that there were peaks, prior peaks in debt around World War I, around the Great Depression, the largest around World War II, and the even larger one is where we are. And I'm going to be using the term ratchet effect quite a bit, applied to both public debt, but also importantly applied to central bank balance sheet. At the moment, a big unknown, a big topic, but with a great deal of uncertainty surrounding it is, of course, the question of do these very high levels of debt ultimately make central banks less independent? And that is an issue that I'd like to return to. A second big question with a lot of uncertainty, it has to do with is the increase in inflation that we're seeing temporary or permanent? And the two questions are intimately connected because it delivers the related question mark on how quickly will central banks react if inflation is indeed more persistent than the much of the discussion in central banks suggests. I would like to start pointing out with, I think, what is a recurring theme, and that's flagged in this slide. The early 1980s marked a turning point for de facto central bank independence. And if I was in Wall Street when the US was in deep recession as a consequence, importantly, of Paul Volcker's very forceful tightening and a spike in nominal and real short-term interest rates to fight inflation, which at the time in the US was running close to 14%. Why am I bringing this up now? Well, can you imagine any central bank at the moment being in a position to adopt such a draconian tightening in monetary policy if inflation were to rise significantly and if it were to stay high? I'm going to argue that the ability of central banks to react importantly also depends on the level of government debt historically, and also in the modern context, the level of private debt as well. So in the big surge and emphasis on central bank independence also coincided with a low point in with the low point in government debt, and importantly, with what is by modern standards much lower levels of um private debt. Now, excuse me. Um, I am mostly throughout this talk going to be focusing on advanced economies, but let me also say in passing uh, that while the levels of debt in emerging markets are much, much lower than those of the advanced economies, they are moving higher and have moved significantly higher by historic standards. And um, as Jordan mentioned in the earlier remarks, emerging markets are debt intolerant and have ended up in debt crises at much lower levels of debt. So historically, how have governments reduced debt? I am going to really gloss over most of this, except the two items on this list that have to do with monetary policy. So we know the debts of World War II and earlier debt cycles were debts were reduced through economic growth. Debts have been reduced through fiscal adjustment and austerity. There was a big element of that also at the end of World War II. I will speak to that. Uh, Debt has been reduced through explicit default or restructuring. You may say, why am I bringing this up in the context of advanced economies? Well, it was very relevant in 1934 about 15 advanced economies defaulted on their official debts, their official World War I debts to the U.S. So default and debt restructuring are not entirely out of the picture. Greece, of course, is a more modern example of an advanced economy engaging in debt restructuring. But importantly, I'm going to focus on the next two items in this list, which what has been the role of monetary policy through inflation and through financial repression in debt reduction. But before I do so, let me make sure that we understand what is meant by financial repression. What are its aims? What are its features? And what are its outcomes? In terms of aims, the aim of financial repression is fairly straightforward. Financial repression, which delivers consistently very low or negative real interest rates on a sustained basis. Financial repression makes governments financing cheaper, and if accompanied by a balanced budget, actually it is a tax, so it helps reduce government debt. So financial repression helps liquidate debt, or at a minimum, it reduces, it keeps a lid on debt servicing costs. Another aim of financial repression, which is very important in periods of high indebtedness, is to reduce rollover risk for governments. In eras of financial repression, central banks hold a large share of the government debt, and financial regulation often requires institutions to also hold a high level of debt. So this has a mitigating impact on rollover risk. Um, the aim of financial repression is clear. The means by which it is achieved, uh, I think, merits some discussion. There was the means of how it was achieved in the past after World War II, and how it's being achieved since the global financial crisis. I'm saving the comparison of the two episodes for later. Uh, but one of the deliverables, one of the outcomes of financial repression is negative, sustained negative real interest rates. Now, what this chart shows here is the share of advanced economies, that's the left scale, the share, and the actual number of advanced economies with negative real short-term interest rates. This is advanced economies only, since the end of World War II. And I think a takeaway of this slide and the next slide is to really highlight that since the global financial crisis, the duration, the synchronicity across advanced economies of negative real interest rates is surpassing any earlier era of financial repression, any earlier era where real rates were negative. So we are what going from the global financial crisis to now COVID. What has happened really is importantly cementing this trend towards not just low for long, which applies, but negative for long in ways that are surpassing even the financial repression era, as you see from the shaded bars in this chart, at the end of World War II. I would note, this is an important point, that the first part of the financial repression era after World War II, negative ex post real interest rates were primarily achieved through keeping nominal interest rates low. There were a lot of interest rate ceilings. There were caps on bond yields that were a legacy of World War II. And inflation expectations by and large, inflation expectations by and large were not consistently high. They were actually, it's a period of very moderate inflation. Now, the latter stages of the financial repression era, which ended in the late 70s and early 80s with financial liberalization and the resurgence of independent central banking, negative ex-post real interest rates were primarily not a function of very low nominal rates, but rather big, often surprise spikes in inflation. So early era financial repression, primarily done through regulation, low nominal rates. Latter part of the later stages of the financial repression era is characterized by higher, more volatile, and a higher incidence of surprise inflation. Food for thought, uh, whether this may be indicative of the modern era. Um, to continue with the point that by historic metrics, and I will move forward on the issue of central bank balance sheets in a moment, but to finish the point that the post global financial crisis era is one of exceptional convergence, synchronicity, uh, and sustained negative real interest rates across the advanced economies relative to any historic period. I offer you this chart, which looks at the frequency distribution of real exposed short-term interest rates, real exposed short-term interest rates for 3 periods. The era of financial repression from 46 to 79, post-liberalization. This is what I would call 1980 to 2007, the heyday of, or the resurgence of independent central banking as inflation fighters. And then the post-global financial crisis leading into the post-COVID, where we are today, and what we, without getting into the granular details, but an important takeaway from this slide is that since the global financial crisis, short-term interest rates across advanced economies have been negative about 66, 2/3 of the time. Not even in the post-World War II era of financial repression did we see such a sustained period of negative interest rates. And certainly in the era of inflation fighting, the era of, where we saw the big surge in inflation targeting across central banks, and that era between 1980 and the onset of the global financial crisis in 2007, that era was characterized by a much higher incidence of real interest rates greater than 2%. So this is the first stylized fact that I wanted to put on the table. The second stylized fact that I would like to turn to has to do with the and there are many names for this, right? There is the issue of the broadly defined how big is the footprint of the central bank in financial markets. But the fact that what this chart is showing is central bank holdings of government securities as a share of the outstanding stock of government securities, showing this for 3 eras or 3 subperiods, not eras, 3 subperiods. What this shows is not only has the footprint of central banks grown dramatically, first since the global financial crisis. That is the medium gray bar. And then, in a very sudden and draconian fashion, post COVID has led, and this is uh, discussion based on work that Vincent Reinhart and I are doing. We've called it the ratchet effect, a two-step ratchet effect, in which central bank balance sheets uh, ratcheted up during the global financial crisis. There was some normalization, but they never returned. It was never mean reversion, and they never returned to pre-crisis level or anything resembling it. And then enter COVID, and there's an even bigger hike on balance sheets. Now, I mentioned the first takeaway or the first feature, which is how big the footprint of the central bank is in financial markets. But the second part of it has to do, connects back to my early remarks of central bank independence, and you may wonder why. Um, well, historically, monetization, big purchases by central banks uh, of government debt have been historically associated with less central bank independence. Um, More extreme, most extreme, obviously, during a war, right? During wars, central bank independence just takes a back burner, massive purchases of government debt. Well, the purchases of government debt in the advanced economies since the global financial crisis, and then ratcheting it up by an order of magnitude higher post COVID, even surpass many of the wartime uh, uh, standards in terms of purchases of government securities. So this, beyond the size of central bank balance sheets, it raises issues relating to fiscal dominance, relating to central bank independence, and obviously circling back to the issue of what could this possibly imply for inflation. Um, so I would like to, in this graph, which, what, as I said, just to highlight and describe quickly what you see, is you see the period from 2004, where this is very granular data on who holds government debt. It is from Arsenal Alp and Suda. It was developed at the IMF, and it has very granular data of the holdings of government debt for the advanced economies and for a large number now of emerging markets, which I will also briefly show. But without question, I think why we call it the two-step ratchet effect is not difficult to see. It's been across the board. It's been synchronous. You may notice Switzerland is not in there. I will come to that in a minute. Switzerland is the outlier, not in terms of the size of the balance sheet of the bank, but in big outlier in terms of the surge in purchases of government debt across the advanced economies. I would note that for the Eurozone countries that you see here, this is a lower bound. The black bar and the gray bar do not tell you the whole story, because these data show how much, for example, the Bank of Italy owns in its own balance sheet of its own government debt. It doesn't reflect ECB purchases. Okay, so again, the ratchet effect is even higher if one takes that into account. Now, the impact of what I said on, I was looking at it in the earlier slide. Remember, this was central bank holdings as a share of outstanding stock of debt. But as we've seen, the outstanding stock of government debt has risen markedly relative to GDP, first after the global financial crisis, and most markedly so uh, after the onset of the COVID crisis. So, if you were to look at the central bank holdings of government debt, the same data, the same as before, except now we're scaling it by GDP rather than the outstanding stock of debt. The increased role of the central bank is even more dramatic, because uh, debt as a share of GDP has also been rising. Now, what I would like to do next is summarize what some of the um literature on fiscal dominance, inflation, uh, and summarize it in a very crisp nutshell, which is historically these kinds of surges in central bank holdings of government debt are more typical during wartime than during peacetime. In peacetime, they're very uncommon. And in advanced economies, they occur in a much more modest scale. Um, in the late 60s, in the 1970s. But the right comparison for what we're seeing since the global financial crisis, but especially since COVID, is really akin to a war. So obviously the big question is how did, or a big question is, what are the consequences um, of this much greater uh, um central bank financing of government. Uh, to mention, and for the relevant to the discussion of what may lie ahead, um, if you take the data in the data shown in the previous slides for advanced economies and look at its counterpart in emerging markets, what do we learn? Um, well, we learn a variety of things that uh, I think bear mentioning. One is the question of greater fiscal dominance of a very large footprint of central banks uh, in the financial sector is really an advanced economy phenomenon. Yes, emerging markets after the onset of the COVID crisis, central emerging markets central banks engaged for the first time in QE, engaged for the first time in many cases in really counter-cyclical monetary policy. Uh, very often the policy response in emerging markets to shocks have been uh, uh, to tighten monetary policy rather than to accommodate. So, yes, in tandem with what we saw in 2020 in the advanced economies, emerging markets and developing countries moved to more accommodative monetary policy, more purchases of domestic debt, domestically issued debt. And so you would say this, highlighted synchronicity. But let us be clear, the scale that I showed for advanced economies is nowhere present in emerging markets. And one thing that I would like to flag in this discussion, especially relevant to when we become more speculative later on and talk about what may lie ahead, is that for the countries that have historically, not in 1 year, not in 3 years, but over a 20-year period, that's the group on the right hand side of this chart. For the countries, this is emerging markets and developing countries, for those countries in which a central bank had higher holdings of government debt in its balance sheet, these are countries which, on average, have historically had higher inflation rates than their counterparts with smaller central bank balance sheets. And to note, this is an issue that we will return to. Sorry, hitting the wrong. So, what I'd like to do next is moving. We've talked a bit without much detail on the post World War II financial repression era. We have been comparing real interest rates between that period and the modern era, especially the post global financial crisis era. And we have been also discussing the size of bank balance sheets. So, what I'd like to turn to next is, first of all, to do some stock taking that tries to address a question that I frequently get, which is, is it fair to characterize, or is it accurate more than fair? There's nothing to do with fairness. Is it accurate to characterize the post-global financial crisis as an era of financial repression? That's what this slide does. That's what we will discuss next. The second part of the stock taking is really more in the form of a comparison. In my work with Brancia that Thomas Jordan mentioned, I get the sense from the kinds of questions that I've gotten over the years that the big conclusion, was that financial repression, that our conclusion that financial repression indeed in that period worked to, number one, reduce government debt. Number two, do so gradually to the tune, it was a tax. And number three, that it was an era with where financial crises were relatively rare. So the combination of offering another tax venue for debt reduction and the lack of the absence of systemic financial crisis in that era makes it look, which is a fair assessment, quite successful. And the question is, can financial repression continue to be can financial repression be as successful in the modern context? And that involves, importantly, after we do some stock taking, comparing the initial conditions then and the initial conditions now, or not just now, but also right after the global financial crisis, and to what extent can we expect a similar or a very different, or to what extent this time is different. Okay, so let me sort of start with the stock taking, or turn to the stock taking now, and then we will go through the issue of initial conditions. So, what this table tries to synthesize is, if you were to take the definition of financial repression often found in the literature, um, different parts of the literature emphasize different elements, but financial repression is importantly defined as big role for the official sector and financial markets, tight links between government and the central bank, often shown or often manifesting themselves as large central bank purchases of government securities. But it's more than that, and I will go back to that, because it also involves more coordination in coordination between the fisc and the central bank. An important element, recurring element of financial repression is heavier regulation of the financial sector. And specifically, heavier regulation of the financial sector by requiring institutions, whether they're banks, pension funds, etc., to hold higher shares of government debt. Now, in the modern era, we've also often couched this as macroprudential. And in this context, one can debate whether one is creating captive audiences or not, but part of the features of regulation has also been capital controls. And what this checklist does is it basically says that financial repression nouveau does not include capital controls, but all the other elements of financial repression are present. Now, in my concluding discussion, part of the discussion, what I'd like to do is translate what does this all mean. This is always comparing financial repression then and financial repression now. What does this mean for central banks? Does financial repression erode central bank independence? I would argue not necessarily de jure, but very possibly de facto. Financial repression will, I think, produce two outcomes. One is tilt central banks to act asymmetrically, i.e., more willing to lower interest rates than to raise them, for the following reasons. If public debt is higher, the consequences of a more draconian rise in interest rates on public finances is, of course, far more important, something very different of where advanced economies were in the 1980s. If leverage in the private sector is higher and that leverage is geared more towards high risk, central banks, I think, will be more skewed, or there's an asymmetry between raising rates and lowering rates, and will be more skewed or more hesitant to raise rates because of balance sheet concerns. If a period of protracted interest rates fuels asset price bubbles, do market crash fears tilt central banks to more policy accumulation, more policy accommodation? Are there more political pressures at higher levels of government debt? And so if I do this checklist, where we are now versus where we were in the post-war, public debt was high, but private debt was nil. So the issue of financial fragility as a cause for concern in raising rates wasn't present. The issue of concerns about asset price bubbles wasn't present because actually valuations were very far from where we are today. And I hope we can continue to discuss these differences between then and now in the Q&A. But I will conclude that if you go down the list of what may, number one, constrain and, as I said, tilt central banks de facto, if not de jure, towards more accommodation, less perhaps independence as it was known in the 90s and the pre-global financial crisis. And if it may also tilt central banks to acting later rather than sooner. And I leave you with a question that if all of those issues, if those fundamentals change towards later tightening, asymmetry, ratchet effects, what could are we really right to interpret the rising inflation as transitory rather than perhaps more lasting, as was the case at the end of the last era of financial repression? And I hope this is food for thought that we can continue.
Well, thank you. Thank you so much, Carmen, for this really brilliant lecture and also for your very clear language. I see you are not forecasting the return to paradise, rather a quite difficult situation, I think, for central banks. But your very clear warnings are, I think, very important. And it's very, I think, for all central banks, but also for the public at large, to take serious your warnings. Now, we are looking forward to having this Q&A. And I invite everybody to send questions via the chat function so that we can take your question also into considerations. Well, Carmen, before we take the first question of the audience, let me just ask you one point. I think you made very clear this financial repression, the negative or the very low rates. But if I just echo a little bit the discussion that we have among central bankers, so an argument that was not mentioned in your speech is this development of the equilibrium real interest rate. So the argument is usually that we had R star, a real equilibrium interest rate, maybe of 2 to 3% in the 80s, and that eroded to zero. So, for example, in the United States, it's close to zero. So, in order to be expansionary, real rates have to be low the equilibrium. Otherwise, it is not possible to have a positive influence on inflation and the output gap. So central banks were forced to do that because of the macroeconomic situation, and because inflation was very low, output gap was negative. That was then a necessity to do it, and because there was an effective lower bound, QE or to extending the balance sheet was the only mean then to have a more expansionary monetary policy. Could you elaborate a little bit how these views match with your considerations regarding financial depression?
So I am so happy you asked this, because one of my reason for not mentioning these uh, the considerations of our star is not that I think financial repression is the whole story, but I think it's the part that it often gets forgotten. I think in central banking, and please correct me, very often the view is equilibrium real interest rates are low because any range of factors having to do often with productivity, demographics, and a whole range of issues, and often the 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 thought that real rates are low perhaps because we put them there, that it is policy actions, not just it's not, this is a discussion that I have with Larry Summers all the time. It's not just secular stagnation. And I'm not in any way, shape, or form saying that those factors are not important. That in effect, equilibrium rates have moved lower. But I'm still at a loss at how to look at a 20-year period and conclude that the equilibrium real rate is negative. What it says about productivity, so I think that is where financial repression is importantly about actions, policy actions, and I think the message that yes, we have these secular trends um, that have resulted in lower interest rates is an integral part of what we observe. But let's not forget that I think if central banks did indeed decide to tighten aggressively, I'm not saying that. Let's be clear. I'm not suggesting, but if they did, I think we would see um, a turning point in real interest rates. What I'm saying, it's there's a big element of policy in what we've observed. But please reiterate the second part of your question, because I've just focused on the real rate, the equilibrium real rate dimension of it.
Well, the second part was, well, if it is true that this R star is really low or close to zero, then to have negative interest rates, and because there is an effective lower bound, QE finally is
Oh, the QE, of
unavoidable.
course, yes,
So
yes.
the balance sheet increase was a necessity in order to have an effective monetary policy. It's a little bit a Taylor argument here that you have to lower real rates below the equilibrium, otherwise you have almost no impact.
Um, I think that on the QE side, um, the for example, and I'm loath to even bring it up, but uh, you know, there's two issues that I hoped I separated. One is the issue of the focus on expanding the balance sheet to influence real interest rates, um, without necessarily saying anything about purchases of government debt, which is, I mean, this is probably not something you may like, but I often think of the Swiss approach more as a wealth fund, as rather than and then there's the issue of central banks, uh, QE, uh, relating to um, purchases of securities, and it raises a very different incentive for governments, in that lower rates, low for long, and the expectation of further purchases also creates a self-reinforcing uh, cycle for fiscal policy. In other words, what I'm saying, central banks, when you get into that, central banks have moved more from monetary policy to fiscal policy.
Mm.
Uh, and I understand, um, the arguments for the QE. I think, and this is not a criticism of QE, but I think importantly, the post global financial crisis shift has been one in which there is a blurrier dividing line between uh, what is fiscal and what is monetary policy.
Mm. Excellent. Now we have already received a number of questions from the audience. And let me start with the first question, which goes like follow. Well, you showed that financial repression was very effective in reducing government debt in the period after World War II. Do you see any reasons why financial repression might not work as intended this time? Or to put it a little bit different, how exactly is the mechanism of financial repression over the next couple of years really to reduce this massive debt in Europe or in the United States, so that the effective debt, the real debt compared to GDP, is actually lowered?
I think it is quite different. And this it goes to also how I was responding to the QE question in terms of self-reinforcing. But let me outline what some of the key differences are. It worked then. It delivered. Financial repression was a tax, and other things equal, it contributed to somewhere between 2 and 4% reduction per year in government debt, in an average sample of advanced economies. But how is it different? Financial repression then, which when it delivered debt reduction, was accompanied importantly also by a higher incidence of balanced budgets. In other words, the financial repression tax went into debt reduction rather than to increased government spending. That's very different then and now. And an important factor for that difference is advanced economies were coming out of a war with much bigger levels of discretionary spending than what we see today. After decades of growth in social safety net programs and the like, the ability of governments to reduce spending rapidly, to maintain and turn to fiscal balances, uh, was a keystone also in making financial repression work then.
Mm.
I think reducing both economically because of the shrinkage in discretionary spending of most advanced economies government over these decades, and because I think the political economy of the fact that reducing military spending or other programs may be easier than reducing social spending. That is very different then and now. Let me
Mm.
also say that an important difference why I'm more, and it goes back to self reinforcing, that uh, then uh, the low interest rates, because governments could tackle the fiscal deficit, the lower interest rates were not an incentive to continue uh, uh, down the path of a deficit. Now we have self reinforcing. Interest rates are low, therefore, debt servicing will remain low, therefore, we can spend more. And that self reinforcing also applies with very big force for the, and but still answering this question, importantly, a key difference of why it worked then is you also didn't have the private sector dimension that we have now, which is low, protracted low and negative interest rates induce leverage. It provides an incentive to take on more leverage in the private sector as well. It actually has skewed the leverage toward higher risk on. This was not a factor back then. Um, most governments, most countries started that era of financial repression with very low levels of private debt. This is a far call of where we are now. And let us not forget, private debts are private before a crisis, but usually become public after the crisis. So this is a contingent liability story. And finally, on what another issue that I think uh, uh, is, I alluded to this earlier, it's in my slide, is um, financial repression then um, um, was really about on balance sheet. Just financial repression then meant that you lower debts, public debt servicing costs, and that's the whole story. At the moment, actually, lowering financial repression, still other things equal, lowers debt servicing costs to be sure, but it may also worsen the pension side and the off balance sheet, which was not a consideration back then. Let me stop there.
Well,
So
there's
it's more. I'm more skeptical
yeah,
that it could replicate what we saw.
yeah. Well, there's a question that goes a little bit in this direction. So, if you are right regarding financial repression, what is your forecast for the development of inflation in the euro area and the United States, and how long will it take until the debt level is then on a more sustainable path?
I think I can, um, you know, start out by saying that we've our way of thinking about inflation, I think, has also been changing since the global financial crisis. The global financial crisis saw a big surge in bank balance sheets. Uh, it has small compared to what we've seen post COVID, but it's a small, big surge in central bank balance sheets. Yet inflation in the post global financial crisis decade was not a concern, was not a challenge. Inflation, if anything, immediately during the crisis, deflation was a bigger concern. So, in the going back to the ratchet effect that I referred to, is this second surge uh, in balance sheets going to mean that we're going to continue with monetary expansion without inflationary consequences? I think it's dangerous to extrapolate from the aftermath of the global financial crisis for the following reason. There are more, but they're a big one um, is not only is the post-COVID, or not, I shouldn't say post because we're still in the midst of we're still well in the pandemic, but um, the COVID surge in central bank balance sheets um, are not only much greater than what we saw in 2008, 2009, but importantly, they have they have come about in the context of something we didn't have at the end of 2008, 2009, but we had in the 1970s, which is a supply shock. Uh, Post COVID, really, the action was in aggregate demand. In COVID, we've had a lot of action in aggregate demand, but we've also had not a single supply shock, but a multiplicity of supply shocks that are still playing out. Unlike the supply shock of the 1970s, which was pivotal also, if you recall. I mean, let me just say very quickly, before this, the oil shock of the 1970s, inflation in the advanced economies and in the emerging markets was already on the rise. But it was on the rise, you know, in a rather non-alarming, more gradualist pace, but it was on the rise. And then entered the supply shock, oil shock, and the policy accommodation to deal with the oil shock. Both of those factors, as we know, ended up with inflation pressures. I think the danger of extrapolating the post 2008, 2009 crisis benign inflation outcome to the present lies in the fact that COVID, we are seeing every imaginable bottleneck, mismatches of workers and inability of firms to meet their labor needs. This is occurring in a very impacting a broader range of not only industry but services itself. So think of taking the oil shock of the 1970s and breaking it down to something that's much more diffuse across sectors of the economy, diffuse across countries, and diffuse across time because these things are not all asynchronous. And I think one thing that we need to be mindful when we think of whether to view the rise in inflation as temporary or more persistent is, you know, the underlying impact on the supply side of the economy that COVID has had that we really had not seen in the aftermath of the global financial crisis.
Well, Carmen, we are already running out of time, but I hope that we can still take two questions because they're really good ones. Well, do you see any alternative to financial repression at this moment? And what, in your view, is the best way to reduce debt? And do you see any hope that, for example, growth could be big enough, strong enough to reduce debt over time?
So, 2 points on that. I don't think that growth alone is more a hope than a policy, right? Saying we're going to grow our way out of this is that's hopeful, but it's not really a policy. If you look, Ken Rogoff, Vincent Reinhart, and me did a paper in 2015 on dealing with debt, which looked at the advanced economies and how have they reduced debt in the past. And that was that menu that I showed in the slides, right? You know, and what was our takeaway? Our takeaway was that um, in cases for countries where the rise in debt is more moderate, the debt reduction was actually achieved through more orthodox measures historically, meaning part of it was growth and part of it was fiscal belt tightening, whether it was higher taxes, lower spending, or a combination of the two. Uh, in cases of higher, coming out of much higher, where much more draconian debt reduction is needed, that's when you start getting a little less orthodox. And we saw, because it's a much taller order to deliver fiscal adjustment on that scale, so there's more financial repression. There is more inflation surprises. Uh, And again, I think people lose sight and associate debt restructuring entirely with emerging markets. But, you know, in the 1930s, um, we had advanced economies, debt restructurings. In the global financial crisis, we had Greece and very close calls in some of the other periphery countries. Uh, that cannot be ruled out. So this is, I, but I do want to leave the message that none of these, all of these are taxes, by the way. They're all taxes. Inflation is a tax. Financial repression is a tax. Um, Debt restructuring is a tax on the creditors. These are, so what lies ahead? I think more taxes. And this goes back to the point that I made, that coming out of the war, there was a lot of capacity to curtail spending. Now the social safety nets we've created over decades make that path more difficult. Hence, what do I think is the end game? I think part of the end game will involve more taxes, but again, don't rule out that we see a lot more of the less orthodox.
And Carmen, really the last question. Can we avoid fiscal dominance? And what do you recommend to central banks in order to keep their independence, and not only de jure, but also de facto?
Um, so, uh, I think keeping it de facto also requires, uh, you know, making very difficult decisions. I don't really think there are silver bullets, because remember, I've also highlighted the breaking the self-reinforcing cycle is going to be very difficult, because what as I highlighted, I hope I didn't leave the impression that the only reasons that central banks may skew towards tightening later perhaps than they should, and create an asymmetry between easing, more of an easing bias than a tightening bias. I hope I highlighted clearly that it wasn't just about what it does to the government finances. It's importantly also about financial risk that a protracted period of interest rates have also built in and become self-reinforcing. Um, so what can central banks do to uh, uh, break out of this? Um, I think at the moment it is uh, it is somewhat limited, but I do think that certainly one part of the safeguarding, uh, um, safe greater safeguard to de facto independence involves also really big impacts on uh, financial fragility. Um, how do you generate regulation that offsets the incentives to take on more debt, the incentives to have, we have contracts where there's a real decline in the quality of those contracts. Um, so breaking the cycle of risk taking and higher leverage, it's difficult to do without pricking a bubble. And that, so you see why I'm saying it's A is not easy. B, I think that we can't really rule out not just the political economy dimension of pressure from the government, but does a central bank really want to be the one that pops the bubble? I think, this goes in that's why it's been self-reinforcing. It's a tough question.
And it is a very clear answer and also a tough answer. Well, Carmen, let me thank you so much for this brilliant lecture. It was really a pleasure and an honor to have you here for the Karl Brunner Distinguished Lecture. And we also enjoyed the Q&A. We got many very interesting questions from the audience. And of course, you had very insightful answers. And I think the topic is so difficult and it will, I think, accompany us for a very long time, especially in central banks with all these critical questions regarding the long-term independence, as you mentioned. I wanted to ask you, what is the one thing that you would like to have people take away from the lecture? But I think your last answer was really very strong, and I think that gave already a clear message. But Carmen, is there anything else you would just like to stress so that people, when they go home, will never forget when they think back to this year's Karl Brunner lecture?
I think, to be concise, things indeed are different, but there are elements that may not be. So I really still think that a big takeaway is complacency. Treating bad shocks as temporary has been a mistake throughout history. And I think that is the big takeaway, that we really want to be careful of viewing, and this goes back to our discussion of is inflation temporary or permanent. There are real dangers of treating bad shocks as temporary and good ones as permanent.
So thank you so much, Carmen. I think that was a real excellent final point, and we are looking forward to having you here in Zurich in person. And we promise to organize a dinner when you are here with a series of academics and business people so that we can continue our discussion. So thank you so much. And I would like also to thank all the online participants for your interest and attention. It's an important point for next year. You should put that in your diary. So next year's Karl Brunner Distinguished Lecture will take place on Thursday. It's always a Thursday, the 22nd of September. And we very much hope that the event can take place again at the ETH Zurich so that we can meet you there in person. So thank you so much and have a pleasant evening and see you soon. Thank you very much.